Okay, so today is 9/15/2024. We're just going to do a quick weekly summary of what I'm looking at this week and talk a little bit about the small account. So I'm going to really start trying to trade the small account next week, and we've got all the rules in. Does anybody have any questions, comments, suggestions about the rules? If you do, throw them in the chat. Um, I want to be very clear about the way that I'm going to be talking. Um, when when I say I'm going to make a trade in the small account challenge, like the rules are I have to type it out. So if I can't type it out and I say, "Hey, I'm buying this and I'm scalping this or whatever," that's not the small account. That'll be my larger account. Um, I've thought about not even trading except the small account, but I just don't think that I'll have the needed motivation. Does that make sense? So I still think I need to trade my larger account, and there'll be times where I'll play ICBs that are playable within the small account, and then there's some that will not be because of the speed. So anytime that I do anything with a small account, it's going to be put into the chat and typed out exactly how you guys want, hopefully, and the buys, the sells, and all that kind of stuff will all have to be typed out. Does anybody have any questions on that? So tomorrow when I'm trading with Nate and everybody's asking me 1,000 questions and I'm like, hey, I'm going to play Tesla as an ICB. Well, unless you see that in the small account, then it's not going to be one of those, right? Like Tesla's an ICB weekly that I want to play, but I would not play this one in the small account because it's too fast and it could get to the target range within 2, 3, 4 minutes. So by the time I got triggered in, I might have to be typing that I'm getting out. Um, but something like CMG, I'd be much more likely to play in the small account. Okay, with that being said, let me just kind of run through bros. Let's see. I don't see what you're saying. If Bros gets a 50 cent cut, maybe Rev Strat down. So like, I see what you're saying. So like, if it pops up 35 ish and then rolls over, is that what you're talking about on Bros? Um, but here I'm gonna switch the stream to my PDF here. And one of the things I want everybody to be aware of is when you're when you're going fishing, it's highly important to pick a lake that has the fish and everything that you guys want, right? And I think we are going to really start seeing a change in that. And the others are going to do, the Max 7 are going to do well. But I think the others are, it's rate cuts are going to start pushing a lot of other things like XBIs, small caps, industrials, dividend stocks. There's going to be a lot of money flowing elsewhere. And we need to make sure that we have those in our master watch list so that we can partake in them when they start doing that. Can everybody see the PowerPoint? Okay, so again, seasonality of September. Yeah, it's rough. It started out rough, but again, I still think we can go back to all-time highs. I don't think we hit them yet last week, so I still think that's a possibility, and then we get some weakness. But again, I want you to understand that this weakness that I think we're going to get, I don't think it's going to be this huge weakness. Like I think there's going to be a lot of uncertainty and there's going to be a lot of chop, but I don't think we're going to drop below the lows that we've already hit back here. I think this level will for sure hold. And to be honest with you, I wouldn't be surprised if this general area holds. Maybe we pull back and create some type of double bottom, lower right shoulder, inverted head and shoulders. But I'm not expecting like, this huge pullback. It's just what happens is a lot of people that have a lot of money become very nervous when they don't know what's happening, and the market likes certainty. It's like, who's going to be president? Trump, Kamala, whatever. Nobody knows. What policies do we know are going to be in effect? Nobody knows, and so I think we're going to get some volatility. Volatility gives great opportunities for day trades. What I'm going to try to do with the small account is day trade the SPY, the Qs, IWM, some of these indexes, because I think there's going to be a lot of that opportunity here over the next 6 to 8 weeks. Now, where we are currently, this is expensive relative to 10 years, and this is cheap relative to 10 years. The only thing that's cheap relative to 10 years is the S&P 400, 600, that's small cap, mid cap, right? Everything else is right at or higher. And one of the things to understand is where we are in this phase, right? Like, what phase are we in this process? Well, we're literally coming into phase one, right? Where we had the downturn, we're starting to curl out of that, and that's small caps and emerging markets. And you want to get higher risk assets, because these people that are cheap right now on a whatever ratio you want to throw at it are going to be able to borrow money at a much less expensive rate. Therefore, their profits go up, and it's easier for them to get money, and so they can expand faster. That's why small caps are projecting to grow by 35%, not this next quarter, but the quarter after, right? Like, let's get some cuts in, and we'll see where we're going. So one of the most common arguments that the bears have on small caps is 41% of small caps are not profitable. And they're right. There's a bunch of reasons for this. From, you're talking about, people that are biotech. Of course they're not profitable. They're developing drugs and blah, blah, blah. Well, the only thing that matters to me is, yes, well, every other time we were about the same place or higher, right? So 41%, 46%, 53%. It doesn't matter when it is. Tech bubble, financial crisis, COVID-19, and here we are. So, yeah, that's true. But what is different about this time than the previous time? Why wouldn't people start flowing money into these other, smaller companies? Like, what's the difference between these three and this one? Well, I don't see anything. I don't see any difference in it. If there is, that's just something that I don't see. So I personally think small caps, and I am loading to the brim on IWM and small caps. I'm doing it through individual companies and the ETFs. One of the things that you guys know I love is BABA, right? Emerging markets. And all I got to say is, my gosh, it's about time. And some of my colleagues sent me a message, and they were like, hey, we're up pretty good on BABA. Should we take the profits? And I said, hell no, you shouldn't take profits. This is what I've been waiting on all year with BABA. I just didn't know when the cuts are going to come. Hopefully, I think they're coming this week, right? Emerging markets are 2 standard deviations below their average. What we were talking about, remember their safety and extremes? When we get to 2 standard deviations and then we reach a VP level, how often am I going to try that bounce? I'm going to try that bounce every time. Every single time I'll try it. Doesn't work, I'll cut it. We'll try the 3 standard deviations, which means it's a higher percentage chance of going back to the average. And so this is where we are, and I can't emphasize this enough. They don't come around often where it's this lopsided. And so, like, you do whatever you want to do with your account, but I think we have a once in every few years, maybe 5-6 year period where we can hit a bottom on something that will grow dramatically. Now, the international does well in a 4 to 5% range. I personally think we're going there. Does anybody think we're going lower? than 3%. And what I mean is in this cutting cycle. So, for example, what do you guys think that the feds are going to cut and why and how much and blah, 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 right? So, the way that I think about it is I personally think the Fed wants inflation to run above 3%. I think they want it between 3 and 4. Go back and look at how often that inflation has been at the numbers that they want. It rarely is. And there's always a reason for it. And when the US GDP, right, when the debt to GDP ratio got out of control, what did we do after World War II? Well, we ran inflation hot for a decade. And I think that's what's going to happen here. So I don't think that they're going to want to cut it too much. They're going to do this balancing act of saying, hey, we think we want inflation to get to our target price stability, but in reality, that's not what they want. So I think they're going to keep it around 4. Like worst case would be 3.5, but I honestly think they're going to keep it around 4. So what would that look like? Probably 0.25, 0.25, 0.5, or to start with, and then or 0.25, 0.5, 0.25, right? Cut that point, and then get us back closer to neutral. Do you guys know what I mean when I say neutral? Does that make sense? Does everybody know what neutral means? Like, if inflation is 3%, and so we raise rates to 10%. Does everybody understand that? Like, what you want to do is you don't want restrictive. You don't want this huge restrictive rate. You want it to be neutral. And I think that's what they're going for. So the S&P 500 sector and industry valuations, one of the things that jumped out to me on this is energy. This is what I was talking about at the beginning. Money's like a river. It continually flows, right? A lot of people think that you got to grab this money and hide it and put it underneath your bed. Money's always flowing, and our job's simply to put the bucket where the money flows. So how do we do that? We find out of favor stocks, get in them before they become favored. And so I think energy is in that realm right now. We have a couple energy stocks, but there are others that I really, really like. And so I'm going to start trying to accumulate good companies for either long-term investment strategies, or just like maybe a longer-term trade. And I think I get into the difference on that here in a little bit. Yeah, right here. So we just had the largest weekly outflow from energy funds since June 2023. And so the difference between the long-term value investment or as a value trade is, when I think of a value investment, my goal is to get 100%. That's always going to be my goal. And I usually think that we can get there, 2 to 3 years. And so the ROIC, you're going to come back with 33%, which is amazing. That's better than 90% of hedge funds. And if I can do that, that's great. Hopefully it can be something like VFC or some of these other ones that work quickly, and it'll work out. But you're always going to have ones like what Intel just did. You'll buy a stock that's down 80%, and then it'll go down to 90%. Well, what does that mean? You literally just got your stock cut again, right? You go from 80% from the top down to 90%. Well, you just lost. You added that 10%, which is a huge drawback on what you invested in. But then after you lose that 10%, it'll go up another 60. That's what I think Intel is doing right now. So these are the difference between them. And I'll make a list, and we can put it in a watch list just for energy companies. And so if you guys have any energy companies that you're like, hey, I've always liked this one, let's look at them, go ahead and either throw them in a DM to me so I can research them, or into the main chat. Now, this is the IBD 50 growth index, and these guys are going up, right? The earnings power of these 30 stocks went up by 6 in the past 60 days, right? 2025 earnings rose 5.6. This is what we want to see. There are others that are moving in the opposite direction. When we are looking for a recession, I think we're going to see the majority of these moving down. You're not going to have ones that are moving up like these are. This is just talking about income shifts. Now, this one, again, this is, I forgot who did this. This is somebody's Twitter. Somebody tweeted this. But it says below are historical uninversions that have remained uninverted for at least a year in the S&P 500. So he says, hey, I count 6 uninversions since 1976. The average 1 year forward total return is 16.6, and 4 out of 6 stocks end higher. A more balanced picture for these saying yield curve uninversion equals stocks are doomed. And so I think this just gives you a, what he said, a more balanced view. And I promise you, when things go down, the bears come out of the woods and they're like, I told you. Just like at the beginning of September, I can't tell you how many people were talking about, here comes the crash, NVIDIA crashed the market. We can't lose focus of the big picture. Help me do that, because some days I'll be like, man, maybe I'm wrong, right? No, it's literally a day. The market's down 2% in a day. Who cares? It doesn't matter. And so we need to be focused on the bigger picture, because the bigger picture is this. The bigger picture is the Fed's cutting. We, as of right now, do not have a hard landing coming in, right? We're not looking at a recession. And literally 1 month, 3 months, 6 months, 9 months, 12 months, we're 100% winners. So, well, what does that mean? Okay, well, they cut on September 18th. Historical data tells us by October 18th, where are we going to be? Well, we're going to be positive. And so the average return is 5%, 9%, 14, 16. I mean, it's a lot. It's pretty good, right? Considering that you're talking about doom and gloom. So this right here, like what I would do, and if I were you, is I would literally print this out and put it on the wall and say, this is the overall picture. And so no matter what I'm doing, if I'm trying to play, let's say Apple or some other stock that's getting a pullback or whatever, and you're like, all right, yeah, I would like to take this, and maybe get 100% winner out of a 2-week option. Well, if you can do that, if you get to the point where you can get 100% winner out of a 2-week option, why not go ahead and say, you know what, man, if I can get 100% out of these 2-week options, let me buy a 6-month option. And then when I get that 100% out of these options, man, that's going to cut my cost basis down on that other option. And shoot, I could probably get 200% out of a $15 option instead of a 100% winner out of a $2 option. And that's how the money really starts to pile up. So the main thing that's happening this week is the FOMC cut, right? I'm expecting 25, but the only thing that really matters is how they talk. If they come out with a 50, I think we're going to get a fall, a general fall reaction, and people are going to be a little bit more nervous. But if Powell comes out and he's very dovish instead of hawkish, then I think we're just going to bounce right back. And I think he will be dovish. I think he will say things like, we've got inflation where we want it. We or go ahead and we're cutting this amount because whatever, job markets, we want to make sure everybody's got a job, blah, blah, blah. And he'll spin it in a dovish direction. If he does not, it's like, all right, maybe we don't try to, depending on where we are, maybe we don't try to push this another, to all-time highs or whatever, and then they roll it up. Maybe it's just going to roll now, and we need to wait and set up for better long-term setups instead of shorter pops. So for this week, we talked about CMG. I love it. I'm going to play it. And some of the other ones that I like are, I like this Netflix chart and I like this AXP chart. Now, the problem with these is obviously they're out of the buy zone. So what I do on these is I'll set an alert that says, hey, when it hits the ADMA, let me know. And then I'll come in here and I'll start buying it up. If I do play these, then I will put them, if I play them in a small account, I will put them in the small account challenge. Some of my other favorite charts. This is another energy play. I really like this chart. Um, so that's a good one. I think we all know Costco. Tesla I've already talked about. VLTO is another one that I like. AMGN, you guys know we've been playing that one. UNH. I need to take that one off. It's already. That one too. Netflix, I think we talked about. So on PLTR, guys, what I'm hoping happens on PLTR is now that we've got this kind of extension up into this range, that we get a pullback and a longer time frame squeeze. I still like this chart, still great, but I'm kind of done playing the shorter term. We've gotten what we've wanted, and I'm looking for a longer term squeeze in it. ASL is one of the semis that I'm watching. I don't know if you guys know what these guys do, but they pretty much have a monopoly as well, and it's putting in what could be a lower right shoulder, which is my favorite type of chart to play for a double bottom. Right, I love that lower right shoulder, and maybe we can start getting another bounce. XBI, again, the small account that we were practicing in. I hope some of you guys are still holding those. I just had to stop out because I put the hard stop in there. This chart again, we're going to rip. It just looks like it just wants to rip. So if it gives me another entry, I will take it. IWM, I think we've talked about. Yeah, this one, it's a little extended. So the other thing that I'm in that I think will do well is just the regional banks. The gap between the big banks and the regional banks is pretty large from a valuation perspective. If you're good enough to pick an individual bank, I know Marlon was talking about an individual bank. Great, go for it. But for me, I think the play is, instead of trying to pick an individual bank, I'm just going to go with the regional ETF, the KRE ETF, and I think this one's going to catch up with the other. It won't catch them, but it will start to bridge the gap. And then we have some of the housing plays, right? Like I think, who has earnings this week? Is it? I think it's Lennar. So when's DHI? Yeah. So Lennar, I think, has earnings this week. So if any of you guys are in DHI with me, remember we talked about playing these as, and this is what I'm talking about. Remember we were over here and I said, hey, I'm gonna play DHI on this TTM squeeze. Does anybody not remember this? And I said I'm choosing DHI to play longer term because they have more new homes, and so the millennials that are looking for houses will be buying their homes more than others, and so I think they've got a shoe in on that one. So I think they will outperform, and so that's what I'm talking about doing this next week as well with anything else that we're buying. It's like I think we're going to have some time that says we're going to get a pullback. We're going to get that volatility, but let's not lose the picture of what's happening overall. And then for you guys that like breakouts, GE clearly broke. And I know Nate's been playing this one for a while, but if you like playing breakouts, GE is one that just as clear as day broke last week. So those are some of my favorites. And let's see, Netflix. So are those some of that you like as well, or are you typing in? Okay, so I think you're just typing in what I was saying. Yeah. Okay, so that's it, guys. Good, we got done in about 30 minutes. Does anybody have anything that we should add, talk about?